tonight's class. We are going to look at this topic you can see on the screen. I hope you can see my screen clear from your own end there. We're going to look at internal control and fraud prevention. Internal control and fraud prevention. That's the topic we're going to look at tonight. Now, as a way of introduction, we said protecting the asset of an organization has always been an important responsibility of management. However, the incredible advancement in IT, as well as the pervasive use of IT across firms of all sizes, have dramatically changed how managers establish and monitor internal control. Indeed, pervasive of IT also has profound impact on internal and external auditors and how they assess the strength of the internal control environment. Protecting such assets requires organizations to develop and implement an effective internal control system, a system that can also perform such other functions as helping ensure reliable data processing and promoting operational efficiency in an organization. This is just an introduction that for every organization to achieve its objective, there's need to what? To safeguard its asset. There's need to what? To put control in place. If it will what? It has to, it will enjoy, it will achieve its objective, they must put a control in place. Otherwise, that set objective might not be able to be achieved or attained. The goal cannot be attained because of what? There might be issues. For instance, with the advancement in IT, as you can see, people will use computer, use internet systems, and the rest of them. And if you don't control that, it will affect your organization negatively. They may use it to defraud you. So that's what there's need for internal control with the growing or with the advancement of what? IT. Now, what is internal control? Internal control is a process effected by people at all levels of an organization designed to provide reasonable assurance that the organization will achieve its objective. So any process that has been put in place by a group of people that is at all levels of organization, whether from the top, that is from the top, the middle, and then the lower class or lower level of organization. These are what processes that put in place so that what the organization will be able to achieve its objective by what? By safeguarding its assets and resources, providing accurate accounting data, promoting efficiency or efficient operations, and then ensuring adherence to policies and regulations. So, we'll talk about internal control. What are we trying to do? We are trying to put in place a process that will ensure that what our assets are safeguarded, that we are providing accurate financial data, and that we're promoting efficient operation in our organization, and then we're ensuring that what there is an adherence to policies of the organization as well as what the external regulations that we have. We have another one says, internal control refers to the process, procedure, and policies implemented by management to ensure accuracy and reliability of financial reporting, compliance with laws and regulations, efficient and effective operation, and safeguarding of assets. This is another definition. So, internal control is put in place by what? One thing that is you need to know here is that it's put in place by management. Management are the one to put in place that those policies, those procedures, those policies that will ensure that what these items are achieved or these objectives are achieved in an organization. Accuracy and reliability of financial reporting, compliance with the laws and regulation, and also the internal policy of the organization, with effective or efficient and effective operations organization, and then safeguarding the assets of the organization. The management are responsible for putting in place this control system so that the organization will be able to achieve all this. Now, the next one says what internal control is a process designed to provide reasonable assurance regarding the achievement of objective in the following categories. That is, you are trying to provide what an assurance that's reasonable that you'll be able to achieve this objective. One, effectiveness and efficiency of operation, reliability of financial reporting, compliance with applicable laws and operations, and safeguarding of us. If you look at something that is common is what the objectives are the same. From the three definitions I'm giving you, the objectives are the same. Talk about what accuracy and reliability of financial reporting. We talk about what compliance. Talk about what efficiency and effectiveness of operations. Talk about what safeguarding of assets. These are the four objectives of what internal control. One thing you should know that what it is put in place by management. Management are the one or are responsible to put in place this system or this procedure so that the organization will be able to achieve these objectives. Now, what are the components of internal control system? We have the control environment, or these are what? These are standard processes and structures that provide the basis for what? Carrying out internal control, including ethics, standards, tone at the top. This is what we call the control environment. The environment, control environment, including what? The ethics, that is what you have. What are the standards that you have in place as an organization? What is the tone? What does the management say? Who are the top? What does the boss say? Does it speak for or against the internal control that you put in place? Talk about control environment. We talk about what risk assessment. This is the process that what inform policies and procedure or control. You are trying to what assess the risks to enable you to provide a policy, to provide a procedure, or to provide what a control. Now, what you do here is you now review your processes in place that you put in place and then see, is there any risks? If there's any risks, what do you need to do to protect or to prevent these risks from happening? It might be a policy, it might be a procedure, it might also be a control. Then we have the control activities, policies, procedures, techniques, and mechanisms in place to help reduce risks. So what you do, what you put in place the policies, put in place the procedure, you put in place the techniques and mechanisms so that what you reduce the risks. This could be things like what authorization and approvals. This can things like what segregation of duties, and next one is what reconciliation. For instance, when we talk about authorization and approvals, before any transaction is concluded, there must be, let's say, 3 people. The first person will initiate transaction, then another one will review the transaction, and the last person he will be the one to approve the transaction. We call it what authorization metrics. So it has to go through these 3 different people. To talk about what segregation of duties, that is an activity or a transaction should not be carried from the beginning to the end by one person. No. Just like I give an example here, person that will initiate should be a different person, person that will review should be a different person, person that will approve should be a different person. That means what? The duty has been separated. That's what we call separation of power, division of labor in every transaction. Then the last one is what? Reconciliation. You try to reconcile. Is there any discrepancy? You check after you reconcile, you go through and review and see whether what you intend to achieve has been achieved, or what you intended to, is there maybe there's a problem, you reconcile, trying to see what is the cost of the difference, and then what is the result of what is the cost of this difference, and how do we now resolve these differences. The next one is what? Monitoring. After putting in place the processes, policy, procedure, you monitor. That means you evaluate the control over time. You see, okay, what the policy you put in place, are they really working? Are they really producing results? The techniques you put in place, are they really giving you what you want? The medicine you put in place, are they really giving you what you want? You monitor and review. And then if you discover that there's a problem, you effect correction immediately. You monitor all the time. Then the next one is what? Information and communication. It must be flow from top to bottom and backward. It can come from top as what? As instructions. It can come about as order from the top. Then from down upward, it could be what? It could be feedback from the lower level of management, or the lower level of what that is the employees. You give feedback. Probably your boss asks you to do certain tasks, and then you're unable to achieve the task because of one reason or the other. You give him feedback. This is what happened. This is what happened. This is what happened. This is the challenge I face. So this what is connection from downward up going upward. While the one that's come from top to bottom is what it could be an instruction from the management. It could be an order. It could be anything. As commission must be what? Must be upward and downward. When you have only a top to bottom communication, there will be a problem, because management will be passing information and we don't know whether the information is being understood by the employees, or maybe whatever they are giving is being carried out, or maybe they don't know whether there's a problem. So when there's a feedback, they will know, okay, this is what we've given, or this is what we're giving to the employees, and this is what we're getting as feedback. Maybe there's a problem somewhere. You will now begin to look inward and then address that problem. Now, who is responsible for internal control? Who? Internal control are everyone's business. Everyone's business. Though leadership is ultimately responsible, everyone in an entity has some responsibility for organizational internal control. As I ever said, the internal control system is put in place by the management. By the what? Management. That could be what? The leadership of the organization. But it is everyone's responsibility, from the top management to the least employee in the organization. It is your responsibility you are responsible for what? For internal control in your organization. Talk about, say, all personnel should be what? Responsible to effect internal control. You must be responsible to allow internal control to be implemented. Control communication controls and communicate problem in operation deviation from established standards and violation of policy or law. This is what I've just explained. So, as an employee, you may communicate a problem in your operations, or you may see a deviation from what the established standard of a violation of what? Of a policy or a law. So you communicate. So everybody is involved when you come to what? To internal control. But remember, the system is put in place by the top management, or by the management of the organization. Now, management role. As a management, what do they do when it comes to internal control? What they do here, if you see this side, it's a cycle. It's a cycle. First of all, they develop a policy and procedures. When they agree on the policy, they agree on it, and then they implement that policy. When they implement the policy, they monitor and review it. When they monitor and review, they see there's a problem, they update it. And then it goes round and round and round. That is what we call the management role in what? Internal control. First of all, they develop the policy. They now agree on the policy and procedure, implement it. That is, they put it into work, and then monitor and review. And then what they discover is a gap, they update it, and then it continues round, round, round. Now, why do we have internal control? We have internal control to protect assets from waste and abuse. If you don't have internal control, for instance, staff will misuse your equipment, misuse your stock. where you don't have control, for instance, the use of, let's say, a motor vehicle. Anybody can just carry a key and then drive out with a motorcycle. That motor vehicle will not last. Or you don't have control on your printers or photocopier. People will bring work from outside and then photocopy. And before you know it, what? It will spoil and then need to buy another one. And your paper as well, your place, your A4 paper, you will not begin to misuse it anyhow for their, instead of to use it for the office use, they will use it for what? For their own personal use. That's what self-control helps you to protect your assets from waste and abuse. Now, the next one says it's to promote operational efficiency and effectiveness. Yes, if you want to operate effectively and efficiently, you must what? You must put in place internal control system. Maybe where you have a factory. The factory, there's what we call, there's a procedure or what needs to be done. Let's say not everybody will just go on a machine or put on a machine and then begin to work. No. Somebody must be responsible to what? To operate the machine. And somebody must be responsible to what? To check. But if you allow anybody to access maybe the generator house and then put on the generator and all the time, this one will come in before you know it, what? It will reduce. Sometimes you may have what? A problem. When the generator got spoiled, what happens? It has reduced your what? Effectiveness and efficiency in your production. Not only in productive production frame, it can be also in an office where things are not done properly. It will affect your what? Your efficiency and your effectiveness. The next reason for internal control is to what? Ensure accuracy and reliable records. When you have internal control, that will give us an assurance to a certain level that what? Your records are accurate, your records are reliable. Because where you have maybe in accounting department where you have your document being kept anyhow, anybody can access the document. Somebody can just go and then change other thing or do something. You may not have adequate records. You may not have, if these records are not adequate or complete, your financial reporting will not be what? Will not be reliable. The next reason for putting in place internal control system is to encourage adherence to policy, rules, and regulation. Every organization has policies. Policies are what? Are internal rules put in place by organization in order to achieve its objective. We have rules and regulations. They have laws that govern what the industry, laws of the government of that country or that state. These are laws. So if you have internal control, staff may break the rules. Staff may go against your policies, and that will what? Hinder you from achieving or obtaining your goal. Now we have what we call the components of internal control. Internal control program has 5 components. It has 5 components. The first thing is what? Say risk assessment. You assess the risks before you put any internal control system. What you assess. I'll explain this one, but this is just coming as what? Components of internal control system. So you embark on risk assessment. What can be the risk? Okay, now what will stop me from achieving my goal as an organization? For instance, maybe in an accounting department, let me use that one. You now look inward, okay, what will stop me from providing accurate financial data or financial transaction or financial information? What could be the risks that may occur? You may say maybe one, you are using maybe computer system. Yeah, there could be system failure, It could be maybe theft. There could be anything that may happen to the system. So what are you trying to do? You're trying to assess the risks. Maybe thief can burgle into your office and then cater away with your systems. So what are the things you need to do? Maybe you say, okay, now for the issue of burglary or burgling my office, you will now put in place what? A secure, maybe buy a safe where you keep your system, or you make a policy, okay, staff are to carry their laptops or their system home. And then in case of where you have system failure, you say, okay, you want to create a backup. You back up your data, maybe either online or offline through what? Through USB sticks or external hard drive. Now, having assessed your risks, you put in place the control activity. You carry out the control activity. Just like what I said. It could be segregation of duty. It could be protecting or employing a guardman to guard your premises. Then after that, what do you have? You have information and communication. You now give feedback. You give feedback to who is going to do. Okay, you are the guardman. We employ you. This is what you do. This is what you do. This is what you do. And then you what? You monitor. You monitor. You monitor and then control the environment. From the control environment, you assess the risks or the risks you control activities, information, communication, and then what? Monitor. It goes round and round. We call it what? The component of internal control. Now, why do we need to put in place a control system? We have the following reasons: to ensure that what our objectives are accomplished. Every organization is established to achieve a set objectives. So if you don't put in place internal control system, you might not be able to achieve or accomplish those objectives. 2, to reduce fraud or fraudulent opportunities. Yeah, if you don't put in place, some staff who are fraudulent will take advantage of the loopholes and then what? Defraud you as an organization. 3, prevent loss of funds or other resources. 4, establish standards of performance. 5, assure compliance with laws, regulations, policies, and procedures. 5, preserve integrity. 6, eliminate adverse publicity. And then lastly, assure public confidence. These are the reasons why you put internal control in place. Types of internal control. We have 3 basic types of internal control. We have the preventive, detective, and we have what? Preventive, detective, what's the third one? Preventive, detective, and then corrective. Yeah, preventive, detective, and corrective method. The first one is preventive method. What do? You design to stop an unwanted outcome before it happens. You're trying to prevent something from happening. That could be what? It could be like reading, understanding the policy. Could be what? Review and approve purchase orders. It could be like password to stop unauthorized access to your computer systems. So you're trying to prevent anything I don't want to happen. Stopping an unwanted outcome before it happened. So this is it. Then we have detective. This one from the word detective is to what? Designed to find and correct errors that have already occurred. We have cash. What you do, you can be for what? Cash counts. And reconciliation could be in form of what? You try to compare expenditure versus budget. Could be what? Review your payroll reports. These are what we call detective method. So detective and corrective method. Okay. In this, did this separate the detective and the corrective? They say detective, it is the same thing as what corrective method. So we have basically the two now. Well, instead of the three, let's use the two, but preventive and detective method of what? Internal control system. The next thing is what? What is fraud? Fraud, from the word fraud. So fraud is the act of what? Intentionally deceiving someone to gain an unfair or unlawful advantage, typically involving money or property. It involves misappropriation, concealment, or false statement intended to what? Trick someone. Any act that is done intentionally by anybody to gain an unfair advantage or unlawful advantage over somebody or over an organization, it is what? It is fraud. And this fraud involves what? Money or property. It could involve what? Misrepresentation. What do you mean by misrepresentation? Giving false information. What you're supposed to record is, let's say, 10,000, and you're recording 1,000. You're misrepresenting. Talk about concealment. You're not hiding some information or false statement to trick someone. Is what we call fraud. What causes fraud, or why some people engage in frauds? There are reasons. Reason number one says incentive is what drives an employee to commit fraud, such as what? Financial pressure or supporting a habit such as gambling or drugs. When someone is into drugs, when someone is gambling, of course, he needs money. He needs money to what? To finance his habit. And then he what? If you don't get the money, he what? He will embark in what? Fraudulent activity. He will defraud wherever he's working, whosoever he's working under. He will defraud to support that habit. So these kind of habits are what? Causes what we call pressure on an individual or an employee. So when you have an employee that is into gambling, is into drugs or alcoholism, and then check out his income. If his income is not something to write home about, and he's living this kind of life, and maybe where he's working, and where you place him is a very sensitive place. You have to review and check. You have to monitor him and see. Probably there is something that is happening. Another reason or another cause of fraud is what? Opportunity created from too much trust, poor internal control, and lack of supervision. For example, a municipality not conducting its state-mandated annual audit by independent CPAs or certified public accountants can create an opportunity. The basic purpose of internal control is to remove or reduce the opportunity for fraud. So an employee will get into fraudulent opportunity, or when opportunity provided, when you see an opportunity what? To take advantage. This could be as a result of what? He's trust by the management or by the boss. Too much trust. And when you don't have an internal control system in place, so everything goes. There's no supervision over the employees. That will result to what? An opportunity created for an employee to what? To embark on fraudulent activity. Another reason could be what? Rationalization. When perpetrators of fraud convince themselves that they are not stealing, but rather they are correcting a perceived wrong, such as what? Not being compensated enough. Someone will say, after all, we are the one that generated the income or the money or the revenue for this business. So even taking out of the business is not a crime. They're trying to what? Justify what they're doing. They feel the salaries that are being paid are not enough, are not commensurate with the effort they're putting into the work they're doing. So what they try to rationalize or try to give reasons that what we're doing is not even wrong. We're trying to what? Compensate enough. We're trying to just make ourselves happy because probably management is not giving us what is due to us. Now, how can we prevent frauds? Or how can frauds be prevented? There are reasons, there are systems to put in place, or there are things to do. One of all is what? Segregation of duties. This divide transaction process or functions so that different organizations or units are what are involved. For example, administrative assistant open the mail and log cash received before turning them over to the finance department. You see, this helps to ensure what no one person has the responsibility for transactions from beginning to the end. You separate the duty. One transaction or one activity is what is divided into different parts, and each part is taken over or it is carried out by different individual or different department. That's what we do. That's what we call segregation of duties. Transaction being divided into what separate units, and then different people will what partake. We have physical asset control. Any movement of asset require document authorization. Authorizing the movement, such as what requiring employees to sign out a laptop for use, physical restraint, example including padlocks, fences, and lock files cabinets. So we talk about physical control. We're trying to what we want to see what can we do to prevent staff or employees from having access, unauthorized access to our assets. For instance, we have the laptop. Where we have laptop, do somebody just go in and pick out without filling a document? No, there should be documentation. Can have what we call asset movement register. What do you do there? You have the date, you have the asset you're picking, you have maybe the serial number and the rest of them, you fill the details of that asset, and then the time you're taking the asset, the date and the time of taking your asset, and then the time, the day you return it, what you bring, you sign in and then drop the asset. That's what we call what? We call physical control of the assets. Then the next one is what? You can put in place padlocks where you have confidential information, you have padlocks, maybe in your wardrobe, in your drawers, you ensure that what all drawers have keys. In your filing cabinet, you have keys. And where possible, you can what? Put fences in some areas. Maybe we have an office where yes, you need to fence that place to avoid people from getting into such place unauthorized people to get into such places. You can fence as well. You can also lock your files cabinet, as I've said. This is what we call physical control. Then we have what we call document matching and pre-numbered accounting forms. This help restrict transaction of what non-authorized form and helps ensure receipt and processing of all forms in the sequence issued. For instance, let's say you have the payment voucher, the PVs. The PVs are pre-numbered forms where you have from number 001, 002. So where you have this one helps you what helps to prevent unauthorized or introduction of what new PV numbers into the files. Because when you have maybe you have your number you have your PVs per number from 001 maybe to 1000, and then you have, let's say, 001 or 200, two PVs. You know that what something is wrong. Something is wrong because you know that you should have only one number or one number for each of these documents. There's signatures. Signature provided evidence the document have been authorized and approved. Document should not be valid until what? Until signed. Document should not be valid until they are signed. Yes, I'll talk about the authorization metrics. Where you have one person initiate to write his name, sign, and date. Another person reviews to see whether what has been initiated is correct. The figures, word, amount, date, and the rest of them, he reviews. And the last person what approves. He also review, and then if you find out that all things are correct, he approved, he append his signature, his date, and then that's all, his name and date. Where you don't have signature on a document, it means that document is not valid. Don't ever treat a document that is not signed in an office. You will put yourself into trouble. You will put yourself in a mess. The next one is what? Document countersigning. This demonstrates to a third party that two or more designated individuals have concur on approval of what? Document. Same thing with the first. I'm just trying to explain this one. The same thing. One sign, another person sign, the third person sign. The signing, that's what it has been gone through what the approval processes. Then lastly, we have password and personal identification numbers. Use password and PIN for computer and mobile devices. All computer systems must have password, and this password must be secret to the person using the computer. The same thing with what? You can use your PIN or you can use password. Same thing with your mobile phone devices. Because in an office, you don't know who is who. Somebody think is your friend, it could be an enemy. He can put you into a mess. Maybe you leave your password or you stay without password, and then step out. He goes there and don't do some manipulation in your transaction, and then before you know it, become a mess. So all systems must be passworded. Now, fraud detective measures. If fraud occur, how can we trace them, or how can we know that fraud has occurred? We have what we call audit trail. Many automated systems have audit trail that record every change made to a record. This allows users to want to trace changes back to their source. This is most commonly with an accounting software that I know and I'm using, the QuickBooks. Whenever you make any entry in the QuickBooks and you delete it, it can be traced back. When you just go back to your audit trails, you will see all the changes that have changed. So if you do not go back and check your audit trail and they see changes that were made, were they really genuine changes, or they were made for fraudulent motive or fraudulent activities, we can trace everything that was made from what? From the audit trail. The next one is what? We can detect fraud through review processes and procedure. This increases what? The opportunity of discovery of fraud. Yes, if every process is reviewed and every procedure is reviewed, you can easily detect what? Where there is errors or where there are what? There are fraudulent activities. You can discover frauds. Focus audits. These audits with a very narrow focus and can be done by what? Internal management. Often they have psychological impact on staff, that these sensitive areas are being surveyed. Now, this focus audit is done by what? An internal management. Where you suspect there's fraud, they can now focus their attention on that particular department or on that particular transaction. To just focus where they feel that's what there's a fraud that has occurred. Do not narrow their attention in that department or in that month. It could be a month, it could be a week, it could be a year, it could be a department, it could be a transaction. Do not focus attention to detect that fraud. We have surveillance of key activities. This can inhibit fraud if potential perpetrators know that they are being watched. This could be things like what? Your CCTV cameras put in place. That's why if you go to a bank, everywhere you see what? Cameras. If you go to serious organization, they have what? They have CCTV cameras. What are they? They are there to record all that is happening. Now, if staff are aware that the transaction are being recorded, that will stop them from even trying to do anything funny. So when this fraud occur, you can go back to your recorded recorded videos and then press back, watch it and now see what happened. And there's this story of a customer of a bank. She went to withdraw 200,000 naira, and then the teller, instead of giving her 200,000 naira, he gave her 300,000 naira. And she collected the money, put in her purse, and she left. In the evening, when the teller wanted to balance his account, he discovered that 1,000 naira was missing. He checked, could not even trace where the problem was. They had to go back to their CCTV camera recording, and then when they watch, they now saw the woman. And then they track her down. She was able to refund the money. That is it. The power of what? Surveillance. Surveillance of what? Key activities. If, assuming there was no CCTV camera that was recording everything, that woman would have gone scot-free. Now, another way is what? Rotation of key employees. Don't allow a staff to remain in a particular department or particular branch for a long time. He may be very comfortable. Maybe somebody is in charge of, let's say, holding cash, and then you leave him there for so many years. You become comfortable, and then before you know it, you need to do some funny things. So what would we do? You take him to another place. You bring another person there, you rotate. This involves what? Periodic rotation of personnel with other employees taking over the duties of an employee, preferably without advance notice. You don't tell them that, okay, next week you go to department A or you go to this. No. Just come one day, okay, you leave this place, please, go to that side. You go to that side, you go to that side. You just swap them. By the time you pre-inform them, they will try to cover up a lot of things before the next person comes. You will not see anything. But by the time you take them unaware, you see a lot of things if there is any fraud. Now that is it all about what? Fraud detection and internal control and fraud prevention. Any question?
No. For me, I don't have any question.
Okay. If you don't have any question, we don't have time. I tend to look at another topic. Quickly. Let's look at the next topic. Now, the next topic, if you can see my screen, is Introduction to Management Accounting. Introduction to Management Accounting. Quickly, management accounting defined. So what is management accounting? It can also be known as what? Managerial accounting can be defined as a process of providing financial information and resources to the managers in decision making. Managerial accounting is the practice of identifying, measuring, analyzing, and interpreting and communicating financial information to managers for the pursuit of what? Of an organization goal. It can also be defined as what? As a type of accounting that involves identifying, analyzing, interpreting, and communicating financial information to managers to make informed decisions that support the long-term goals of the company. And lastly, we say management accounting is the provision of financial and non-financial decision-making information to managers. So if you look at this definition, one thing that cut across is what? It is done internally. It is done internally to provide what? Managers with decision, with information that could help them to make what? Informed decision in pursuing what? Its goal. It is done by what? This kind of information provided to managers so that they can use the information to what? Make decision that will help them, or they will help them to what? To pursue their organizational goals. That is what we not the summary of these definitions. Now, objective of management accounting. Why do we have management accounting? It provides data for planning and forecasting. Yeah. From this information that's provided to management, you can use this data to plan and forecast. You make prediction of what will happen next month. Okay, if our sales is this, going by this thing that will happen, looking at these factors. Okay, by next year or by next month, we'll be at this. What are you doing? You're forecasting. You're forecasting your what? You're forecasting. The next one, it also helps in what? It analyzing data such as for calculating ratios and projecting trends for decision making. Yes, we'll talk about ratio analysis. This is management accounting. You can use management accounting as well. And this ratio analysis can be used for project trends or for projecting trends. You can see trends, okay, from the past 3 years. What has been happening? Is there a consistency, or is the sales going upward, or our expenses, is it going downward? It's a trend. And from that trend, you can make a decision. The next one is aiding meaningful discussion to take the best course of action in various stages of planning. So this accounting helps you to discuss meaningfully. You have different course of action, but you not take you help you to choose the best course of action when you're trying to plan. The next one helps in helping convert organizational strategies and objectives into feasible business goal. Each organization has a organizational strategy. So these strategies are broad, but for you to be able to convert them to objective that is feasible, you use the management accounting. Next is using qualitative information such as industry cycles, strength of research and development through survey to make informed decision. Responsibilities of management accountants. As an accountant that is in charge of management accounts, what are your responsibilities? One, identify opportunities for financial investment that can help the company. Okay, first of all, you want to help your company. What do you do? You look for opportunities where the company can invest, and when the company invests, it can also benefit. Your responsibility is to look out for such opportunities for an investment to the benefit of your company. The next one is prepare financial reports like cash flow statement, tax document, asset, and rest of them. Yes, you can prepare reports. Remember, we'll talk about the cash flow statement. Think about tax documents. Think about your assets. You can have this report. Then the next one, it does setting, monitoring, and maintaining budget for a company. Yes, it can set it, can be part of budget preparation. He monitors budget and then maintain the budget for a company. After having done that, he said using financial insights to make strategic decision. Yes, from the knowledge you have, you can make a decision as strategic to the business or to the organization. Then next one is analyzing data for performance improvement. Next one, identifying trends and opportunity for improvement. Then lastly, monitoring and enforcing compliance. As a management accountant, you're also a monitor. You're also an enforcement agent in your organization. Make sure that the company or the business is doing what the law says. That are the responsibilities of a management accountant. Now, let's look at the differences between financial accounting and management accounting. So this difference we'll be looking at in the following. We have the basis, we have financial accounting, we have management accounting. The first one is the definition or meaning. What do we say is management or financial accounting? Say financial accounting is an accounting system that helps in classifying, analyzing, summarizing, and recording a company's financial transaction. That's what the meaning of financial accounting. While financial accounting is what? An accounting system that helps in collecting, analyzing, and understanding the financial, qualitative, and statistical information, ultimately helps the management in making effective decisions regarding the business. That is what? That is financial accounting definition. Now, application. Where do we apply financial accounting? It helps in what? In showing the true and fair pictures of the financial position of an organization. While financial accounting helps the organization in making what? Meaningful decisions and strategies accordingly. Objective of financial accounting is what? To create periodic reports. It could be monthly, it could be annually, could be quarterly, could be weekly. But the objective of financial accounting is to assist the internal management of organization in making decisions. This one is periodic. This one comes at any time. You can be asked, please give me a report on this. Give me a report on this. But this very one is what? Is periodical. It is what? There's a time. Could be monthly. If it's monthly, it's monthly. Or this one, the manager can just come to you and say, please, can I have our sales for last week? Can I have our produce for last week? Can I have our expenses? It can be anytime. Then who are the users of financial accounting? There are both internal, that is the employee, management, etc., and external, the customer, creditors, etc., users of financial accounting. That is the users of financial accounting are what? They are internal as well as external. But for the users of financial accounting, they are what? They are only internal. They are known as what? The management. They are known as what? Management. They're the one that make use of the financial accounting information to make decision. The nature of the statement prepared. The statement under financial accounting are prepared for general purpose. It is meant to work for every user to be able to have what? Study and then get what he wants. General purpose for everybody, but both for the internal and the external users. But for the financial accounting, the statement or report under the financial accounting is what are prepared for the specific purpose, that is for the management consumption. They ask you, please, I need only sales for this year. No, I need only maybe profit we've made over 10 years. They are specific. They don't give you a general report or statement. Then the scope. Under the financial accounting, the scope of financial accounting is what? Pervasive. While that of financial accounting, the scope is what? The scope is broader than financial accounting. It's broader, it's very wide. The rules. Which are the rules that govern financial accounting? We say it what? Financial accounting strictly follows what? The rules of what? GAAP. GAAP means general accounting, general accepted accounting principles. And then for financial accounting, there are no fixed rules while preparing reports through management accounting. So this one, the man say, okay, I want this report to be this way, this way, this way. Show me the date, show me the time, show me the employees, or show me the customer, show me you give you what you want. But this one has what? Has a standard way of preparing it. This one is what determined by the management. Time span. Financial accounting under this accounting system are prepared for a fixed time period, e.g. 1 year. But under the report under the management accounting system are prepared according to their needs. When if the need arises, you can be asked to prepare a report. The base of decision. And historical information is used as the base of decision making because under financial accounting, you are preparing your report based on what has happened. Transaction that have taken place is historical. But for the management accounting, you can make prediction. You can make estimate. You cannot predict, okay, going by what is happening or going by the trend we've analyzed. So time this year, this is where we'll be. You're predicting. Then verifiable. Information presented in this financial accounting award are verifiable because they have occurred. Yes, we'll make sales of 10 million naira, Okay, how do we get this? Okay, these are the people that we sold to. These are our customers. Customer A bought 1 million, customer B 20 million. You have what you sold to them. They are verifiable. You can see them, you can verify. But for dimensional accounting, information presented in the report is predictive, hence not immediately verifiable. You cannot verify because of what? They are futuristic until they occur before you verify. This possibility of what you predict might not occur. Then the formats. Under the FA, financial accounting, there is what a specific format for presenting and recording information through financial accounting. Remember, we talk about what? The trading, profit and loss account, talk about the journal, talk about the trial balance, talk about all the cash book, the ledger account, and the rest of them. They have their own formats. But for the management accounting, there is no specific format for presenting information in management accounting. There's no any specific format. It is what they want that you give. That is it. Now, we have what we call cost behavior. Cost behavior. Cost behavior is the way a specific cost react to changes in activity level. The way what particular cost react in changes to what activity level. Cost behavior is an indication of how a cost will change in total when there is what a change in some activity. But before now, when we say costs, what do we mean by cost? Cost in accounting. If we talk about cost behavior, what is cost? Now, cost now for most of this class, when we say cost, we're referring to the money spent to acquire goods or services. What you spend to acquire goods or to acquire services. We call it cost. Now, cost behavior is what? The way specific costs react in the what? Changes in level of activities. Call it cost behavior. Types of cost behavior. There are three: fixed cost, we have the variable cost, we have the mixed or semi-variable costs. These are what the three basic types of cost behavior. A cost can behave to be fixed, it can be variable, it can be semi-variable or mixed. Now, what are fixed costs? From the word fix, they are costs that are sustained themselves without getting affected by the volume of production or the number of goods and services provided by the company. In other words, total amount of fixed costs will not change when an activity increase or decrease. Because the fixed costs, they don't change with the level of activity. They remain constant through every level of activity. Whether you produce much, whether you don't produce at all, that cost still remain there. You must incur that cost. Fixed costs are those that stay the same in total regardless of what number of units produced or sold. Although total costs are the same, fixed cost per unit changes as fewer or more units are produced. Straight line depreciation is an example of what fixed cost. It does not matter whether the machine is used to produce 1,000 units or 10 million units in a month. The depreciation expense is the same because it is based on what number of years the machine will be in use. Yes. When we look at depreciation, the straight line method, it is fixed. Every year you charge the same amount. Let's assume in a year where you produce 1,000 units, the same amount will what we charge as depreciation for that asset. And whether you produce more than 1,000 units or more than 10 million units, whichever number you produce, it's what the same amount will be charged. Let's look at rent, for instance. When you're paying rent and you have fixed rent, let's say 2 million every year you're paying, whether you produce nothing or whether you produce billions of units, you're still paying that rent. It does not change with what the level of production or level of activity. We call it fixed asset, or sorry, fixed cost. Now, for example, the previous company, suppose it hires a machine to produce the product for 100,000 naira per month. Whether you use that machine and produce 1 million product per month or stay idle and produce no effect, either case, company must pay the same agreed value. I've explained this one. Now, an example of fixed cost is the position and insurance on the bakery facility and equipment. Regardless of the quantity of artisan bread produced in a month, the total amount of provision and insurance cost for the month will remain the same. Now, I've explained all this. Now we have a formula for calculating total cost, total fixed cost. Formula for calculating total fixed cost, TFC, is total fixed cost equals to cost of production minus variable cost times unit produced. That is cost of production. You take the variable cost per unit multiplied by the unit produced. You have total cost of production. You see? You see? Now the next one is variable costs. Variable costs. The total amount of variable costs increases in proportion to the increase in an activity. The total amount of a variable cost will also decrease in proportion to the decrease in activity. So what are we saying? If the level of activity increases, the variable cost will also increase. When there's no production, there won't be any, or variable cost will be zero. When you produce one, it will increase. When you produce two, as you are increasing your production level or activity level, the variable cost will also increase. Variable costs are the cost that changes in total each time an additional unit is produced or sold. With the variable cost per unit, costs stay the same, but the more the units produced or sold, the higher the total cost. Direct materials is a variable cost. If it takes 1 yard of fabric at the cost of $5 per yard to make one chair, the total material cost for one chair is 5. The total cost for 10 chairs is 50, that is 10 times 5. And the total cost of 100 chairs is 500, that is 100 times 5. So you see, as you produce, the more you increase the level of activity, your variable cost also increases. So it increases in proportion to your level of activities. An example of variable cost is the cost of flour for a bakery that produces artisan bread. The greater the number of loaf produced, the greater the total cost of the flour used by the bakery. Now, if you have, let's say, 1 mudu of flour, you will produce, let's say, 5 loaves of bread. That is it. Now, if you produce 10 mud, if you want to produce, let's say, 10 loaves of bread, you have to use 2 mudus or 2 measures. And if you want to produce 15, you want to use 3 measures. So it is based on your level of activity, proportionate to your level of activity. When you reduce it, it also reduces. When you increase it, it also what? Increases. And it has a
Excuse me, sir.
formula.
I have a question.
Variable cost is what? Cost per unit times total number of units. Now we have
I
it
have a,
here. This is
so
what
I have a
cost
question.
per.
I have a question.
So please go ahead.
Yes. So from your definition of variable cost, can we say it is the same as marginal cost?
Marginal cost is not the same. Marginal cost is additional cost. Do you understand? And if you're going to produce an additional unit, it's called marginal cost. Do you understand?
Yes. Yes. Then
It's not
what
the
is
same
variable?
thing. Marginal cost is different from variable cost. I hope that's clear.
Yes, marginal cost is the cost required in producing an additional unit. Then
Yes.
variable cost. Then what's variable cost?
Variable cost is the cost that varies or increase increase proportionally to the level of activity.
Okay. Okay.
Yes. What about marginal cost is what is the cost of producing additional one. But this one is what is talking about the total amount, the increase, not one, talking about the total increase as you increase your what your production level.
Okay. Okay.
Yeah. So we said the formula is what? Total variable cost is cost per unit times total number of units produced. I was trying to give you a reference here. Our cost per yard is 5 naira. If you are producing 10 chairs, we'll say 5 naira times 10. This will give us 50 naira. If you're producing 100 chairs, will be 100 chairs multiplied by the cost per unit. That's what we got. Our cost per unit multiplied by total number of units produced. Now, example of fixed cost. Why am I bringing fixed cost here? Okay, I've done this one. Example of variable cost. Let's say each smartphone produce require a SIM card that costs 12 naira. Each smartphone requires a SIM card that costs $12. If you multiply your intended number of units that you want to produce by 12, then you would get total cost of production. In this case, $1,200,000 equals to 100 SIM cards multiplied by $12. That is it. Just simple. Because we said total variable cost is what? Is variable cost per unit multiplied by total unit produced. So it's just a simple calculation here. This means that the $1.2 million is the total cost of production. This figure provides you with what? An estimate in the event that you want to manufacture more units. By calculating costs, you can track other methods of activity to lead to its production, like labor and sales. Now, if you want to produce, let's say, 1 million units, of course, you have 12, total cost of will be 12 million, because you add zero here, become 12 million. If you want to produce, let's say, less than 100,000, let's say, you want to produce 1,000, I mean, you have what? 12,000 as total cost of what? Total variable cost. So this is a graphical presentation of costs. If you see here, we have fixed costs versus variable costs. Fixed cost is always fixed. It does not change. Look at it here. Look at the cost is here. This is the fixed cost here. If, let's say, your rent is 200,000 naira, that's the fixed cost line. Now, if you don't produce anything the whole year, you're going to pay the same 200,000 naira. If you produce 10 units, you're going to pay the same 200,000 naira. If you produce 20 units, you're going to pay the same amount, If you produce 30 units, the same amount, 40 units, whatever quantity you produce, the fixed cost will remain, line will still remain what? Straight line from left to right, straight line. But when we talk about variable costs, the line starts from the origin, that is from 0, between the y and the x-axis. The point 0 is what? It moves upward, indicating what? That if you're producing 0, if you're producing unit 0, the variable cost will be 0. If you produce 100, the variable cost will be 10. If you produce 200, the variable cost will be 20. Sorry. If you produce 300, the variable cost will be 30. If you produce 400, of course, the variable cost will be 40. So the more you produce, the more your variable cost. The less you produce, the less your variable cost. But in the case of the fixed cost, irrespective of your level of activity, irrespective of the level of what your production, the cost still remain constant, or the cost remain constant. But this one is what is proportionate to your level of activity. Now, the next one we say is what? Mixed or semi-variable costs. A mixed cost contains fixed and variable cost element. It is critical to comprehend how fixed or variable cost elements are related to the sum of the mixed cost. So there's some costs that are what? They have the fixed element and they have the variable element. Fixed element in the sense that that element or that part of the cost doesn't change with the level of activity. While the variable element part, it changes with what? With the level of activity. An example of a fixed or semi-variable cost is the telephone invoices, because they have set costs such as what? Subscription fee and taxes, and other variable costs such as what? Monthly consumption volume. Now, let's just give you, let's say, the smartphone you are using. Now, you buy a phone of, let's say, 200,000 naira. That's a phone of that cost is what? Is fixed. Now, let's assume that phone they sold it in the market 200,000. You bought the phone, maybe 10 people bought the phone at the same time. Now, that is what is the fixed element of that cost. Now, the item you're buying, the recharge card you're buying, will not be the same thing. Someone that make much call or more call, he spend more on what? On recharge card, compared with the person that doesn't make calls. So if you look at this code, it has what? Has the element of fixed as well as what? As variable. So that's fixed element as well as variable cost. We call it what? Mixed or semi-variable cost. Now, example of fixed cost. Owning a machine, building a crate, let's say, owning a manufacturing building to create SIM cards has a total mixed cost. That is it. The cost for instance, the fixed cost of the building is 250,000 per year, and the utilities are 300 per occupant and 150 employee work in this office. The calculation would look like this. That is 205,000 naira. How do you get that? Now, if you look at this one, the 250 is what? Is the rent or the cost of building this manufacturing company or factory. They spend $250, sorry, $250,000. Or that's what they pay yearly. Let's say the rent, $250. And then they pay for utilities. They pay 300 per occupant, that is per employee. Now, if they have 150 employees working in this office, they will not say, okay, 300 multiplied by 150, you get what? You get plus this 250, which is this fixed one. We get 250 plus 150 times 300 to give you what? $295,000, which is equivalent to what? The fixed element is what? 250 plus the variable element is what? The 300 occupant per 300 per occupant multiplied by the 150 occupant. Give you what? If you add, we get 295. That is the semi-variable cost, or the mixed cost. That's how it looks like. Now, the next thing we are going to look at is the cost volume profit analysis, CVPA. We call it CVPA. Some people call it break-even analysis. Break-even analysis. Now, the CVP expresses the relationship among cost, volume, and profit or loss. We're looking at what cost, looking at volume, looking at profit analysis. Now, the cost profit volume analysis is a financial tool used to understand how changes in cost and volume affect a company's operating income and net income. It helps business determine the break-even point, which is the level of sale at which total revenue equals total cost, resulting in neither profit nor loss. So this is a tool that gives us understanding of how what changes in cost and volume would affect our operation or our operating income or net income. Now, it's helped to know, okay, this is the break-even point. What's the break-even point? It's a point whereby you neither have loss, you neither have profit. What you spend is what you gain. You spend 10,000 or 10 million, and you're able to get 10 million. No profit, no loss is what a break-even point. Now, the cost volume profit or the CPV analysis, analysis of total cost and profitability at different level of what of production. It helps to analyze the total costs and profitability at the different level of production. Okay, at this level, what is our profit? What is the cost? At this level, what is our profit? What is our cost? That is what the use of what the CVP. Now, key components of what cost volume profit analysis. Now, the fixed costs, the costs that do not change with the level of production or sales, e.g., rent, salaries. I've explained this one. Variable costs, costs that vary directly with what the level of production or sales, e.g., materials, direct labor. Sales price per unit, or the sales volume. Sales price per unit, the amount charged to customer for each unit sold. We have sales volume, the number of units sold. These are what a component of CVP. Take note, we have the fixed cost, variable cost, the sales price per unit, and we have the sales volume, that is total unit that was sold. Now, the CVP analysis assumption. There are assumptions that are being used when we are analyzing the cost profit, cost volume profit. First of all, you said what? All variable remain constant except volume. That is, all variable costs remain constant except volume. Volume is what? The units you produce. And the units you produce can go up and go down. This assumption suggests that volume is the only factor that can cause cost and profit to change. Factors such as increasing production efficiency, changing sales mix, and price level are not considered. Number two, only one product is being produced or there is a constant sales mix. What is the production? It's what you're producing only one sales or there's what a constant sales mix. You don't change your sales mix. If you're selling curry and sugar throughout, for instance, your sales mix. Do that today, sell curry and sugar, and then maybe next time you add milk, say, no, the curry only. No, you have what a constant sales mix or you're selling only one product. Following on from the previous assumption, CPV analysis only apply where one product is what is being examined or if there are a number of products when they are always sold in the same proportion or combination. Number three, total cost and total revenue are linear function. This assumption suggests that what? That variable cost per unit and selling price per unit do not change. They are not affected by discount. The fourth point says profit are calculated using the word variable or marginal costing. Now look at the marginal costing you're talking about here, please. Now your variable costing facilitates for profit analysis as it separates variable and fixed costs and treats fixed costs as period costs rather than what attempting to allocate them to products. The fifth assumption is what costs can be accurately divided into their fixed and variable element. That's what it is assumed that what all costs should be either fixed or variable. This is a key requirement of variable costing. The suggestion is that where there are semi-variable costs, that they can be calculated split by using the word technique such as what the high-low method. That's what we call high-low method of separating the fixed element from the fixed from the mixed what do you call it, mixed cost. You can separate the two. Now, the sixth analysis, or sorry, the sixth assumption is what? The analysis apply only to what? Relevant range. The relevant range is considered to be a sales volume range between sales of 10,000 units and 80,000 units, within which the selling price and variable cost per unit remain constant. CPV analysis does not apply outside of the boundaries of this sales volume range, e.g., sales less than 10,000 units or greater than 80,000 units. So there has to be a range. Just estimate a range. Okay, my sales will be between this quantity to this quantity, and then this sales should not be less than the quantity you predicted or over the quantity you predicted. No, it should be within the same range. Then point number 7 says what? The analysis applies only to a short-term horizon. CPV analysis examines the relationship between sales volume, cost, and profit during the period of 1 year, and during this time, it is suggested that it would be difficult to change selling price, variable and fixed cost, which is in agreement with the other assumption. So it is done within what? Short possible time, within what? 1 year. And during this 1 year, all costs remain constant. You cannot change your selling price. Your variable cost per unit cannot be changed. That's what that assumption or agreement. Now, the CPV analysis can be summarized by the equation: profit equals to sales times volume minus variable cost times volume minus fixed cost. That is what the summary of cost, volume, profit analysis. So let me just explain this. The selling price could be selling price per unit, or could be unit selling price. Let's say your selling price is 10 naira per unit. The volume refers to the quantity you sold, number of units you sold. Then the variable cost is what? The cost that changes with the level of activity as we've defined and established, and the volume still remain the same unit here that you are talking about here. If you produce 10,000 units, 10,000 units will be here. Now the fixed cost is what? The cost that does not change with the level of activity. When you do this, you get what we call the profits. That's what is summarized or summary of what? The CPV analysis equation. Now, the break-even analysis. The study of cost-profit volume relationship is also sometimes called, or is sometimes called what? Break-even analysis. In the opinion of some, it is what? Misnomer, as break-even analysis depicts what? A point where cost and total sales revenue is same. Beyond this point, it called cost-volume profit relationship. Some hold a view that the break-even analysis can be interpreted in two senses, narrow and broader. In narrow sense, it refers to determine the level of output where total cost equal to total revenue, that is, no profit, no loss. In the broader sense, it is used to determine the probable profit at any level of output. So we'll talk about the break-even analysis, as I've earlier said. There's what we call the break-even point. From where what? There's no profit, there's no loss. So at that point, any sales that is above the break-even point, you make profit. Any sales that's below the break-even point, you will make a loss. So if you know your break-even point or your break-even output or price, so if you want to achieve a profit, you will not produce below the quantity or below that volume. Take for instance, if your break-even output is, let's say, 10,000 units. Now, if you produce 9,999,000, you have a loss. You will incur a loss because it is below the break-even point. Now, if you produce beyond or above the 10,000 units, let's say 10,001 units, of course, you make some small amount of profit on that because you've produced above the break-even point. No, anything that is above the break-even point, if you want to make more money or make more profit, you produce more at after the break-even point. That's what they're saying. Now, the break-even point is the point where what sales revenue equals to. I've explained this one. So, so we have two methods of calculating the break-even point. We have the mathematical method and we have the graphical method. Let's look at the mathematical method. The break-even point through the mathematical method can be found out either by equation method or contribution margin technique. So we have the equation method or the contribution margin technique. Let's look at the equation method. Now, we know that sales minus variable cost minus fixed cost equals to profit. That has been established from our previous slides. Well, we say what profit equals to variable cost. Variables, we have variable cost. We have profit equals to what? Sales multiplied by volume, which is our sales. Then variable cost multiplied by volume, which is our variable cost. Then fixed cost is the same thing as fixed cost. You get your what? Your profit. So we say profit equals to what? S stands for sales, VC stands for variable cost, FC stands for fixed cost, which is what our profit. So take note, when we have S, we're referring to sales. When we say VC, we say that one stands for variable cost, and then FC stands for what? Fixed cost. Now the sales minus variable cost equals to fixed cost plus profit. Yes. If you want to, when you have your sales, subtract your variable cost, will be equal to what? You give your fixed cost plus your profits. That's mathematically. Because if this one is plus, when you cross the other side of the equal sign, it becomes plus. If you want to deal with these two variables, sales and then variable cost. Now, if this is minus, if you cross to the other side of the equal sign, it becomes a plus. That's why we have plus fixed asset plus profit equals to what? Variable times sales minus variable cost. That is S minus VC equals to FC plus P. Now, sales minus variable cost is called contribution. Yes, sales minus variable cost is called contribution. Now, contribution is fixed cost plus profit. You can also see contribution is what? Sales, fixed cost. Let me just use this tool. Contribution is the same thing as well. We say contribution is equal to fixed cost plus profit. This we're trying to manipulate all this formula. Now, so therefore contribution is equal to what? Fixed cost at break-even point. So at the break-even point, your contribution is the same thing as your what? As your fixed cost, or SP minus VC multiplied by Q equals to F, where SP stands for what? SP stands for selling price, VC stands for variable cost, and then F stands for what? Fixed cost, and Q stands for what? The number of units produced and sold, that is quantity. Look at the following illustration, how the break-even point is calculated or is calculated. Now, calculate the break-even point from the following information. Selling price, 3 naira per unit. Variable cost, 2 naira per unit. Fixed cost, 90,000 naira. Estimated sales for the period is 300 units or 3,000 naira. So supposing the unit to be produced and sold at the break-even point is Q. That is, we're trying to look at the quantity now. We have our selling price, we have our variable cost, we have our fixed cost. I will say the estimated sales for the period is 100 units or 300,000 naira. Supposing the quantity, the units to be produced and sold at break-even point. Looking at the break-even point now, at break-even point where you have sales equals to, or sorry, your revenue. There's no profit, there's no revenue. Your cost equals to sales is what is Q. Then the sales minus variable cost equals to contribution equals to fixed cost. Of course, we've established one from our previous slides. We said sales minus variable cost equals to what is your contribution. Also, contribution is the same thing as what as your fixed cost. So in this case, we have sales. Our selling price is what is selling price per unit is what is 3 naira. And we want to know how many units can we sell to make to break even. And we said let the break even point quantity be what? Be Q. Is 3Q minus, that is sales, selling price multiplied by quantity minus the variable cost, which is 2 naira multiplied by the same quantity, equals to 90,000, which is our fixed cost. Let's say variable sale minus variable cost equals to contribution equals to fixed cost. So 90,000 naira. So our Q will now say 3Q minus 2Q is Q. Our Q will be what? Will be 90 units. When we produce and sell 90 units, then total sales revenue is what? Is 270. That is 90,000 so multiplied by what? By 3, which is what? 270. And total cost is what? Is variable cost of 2 naira multiplied by 2. Equals to 180. Now, when you add your fixed cost of 90,000, give us what? 270. As you can see, this at the break-even point, our cost is 270. Our sales is 270, our revenue is 270, and then our cost is what? Is 270. Because we said 90,000 multiplied by 3, which is our sales, which is 270, and then our variable cost goes to 270. We said, how do we get 270? Is 2 naira, which is 2 naira, selling price by unit, and is 2 times Q. Our Q, of course, is 90, it was 190, 180, sorry, and plus your fixed cost. Our fixed cost is giving us what? As 90. When you add all this, you get 290. It has proved at what? At break-even point, there's neither profit nor sales. Sales is equal to cost. This is sales, this is total cost. Or total sales revenue is equal to what? 270, and our total cost revenue is 270. So there's no profit, no loss. What was expended is what was received as revenue. Now, contribution margin technique. This is the first method we use. We use the mathematical method. Sorry, the equation method. We want to use the contribution margin technique. We're using the same question to calculate the break-even point from the following information. Selling price is 3 naira per unit. Variable cost is 2 naira per unit. The same fixed cost, 90,000 naira. Estimated sales for the period equals to 100 units or 300,000. Supposing the unit to be produced and sold at break-even point is Q. Sales minus variable cost equals to contribution equals to fixed cost. Of course, 3Q minus 2Q equals to 90,000. Q equals to 90,000. When we produce and sell this, the same thing. Now, let's look at this one. This is the contribution margin technique. So what do we do? First of all, we're going to look at our marginal costs. Contribution per unit means what difference between the selling price and the variable cost. Marginal cost and cost volume profit analysis. Or contribution per unit is what selling price minus variable cost. Total contribution is what total revenue minus total variable cost. Break-even point can be expressed in terms of units we produce and sold, or in terms of what the value of goods at break-even point. We know that break-even point in unit equals to sales minus variable cost equals to fixed cost. Or selling price minus variable cost divided by quantity equals to fixed cost. Now, break-even point, that's BEP in units. Take note, BEP means what? Break-even point in unit is your fixed cost, which is fixed cost we have in the question, divided by your selling price minus your variable costs, or your fixed cost divided by the contribution per unit. So when we say selling price minus variable cost is the same thing as what? Contribution per unit. SP per unit minus VC per unit is known as what? Contribution per unit. Sales minus variable cost is contribution. But when we say selling price minus, selling price per unit minus variable cost per unit give us contribution per unit. Let's continue. Now, if you can see, so let's calculate the break-even point with the help of above equation by using the information given in an illustration 1. That is that same question. Break-even point in units equals to fixed cost divided by selling price minus variable cost. 90,000 is the fixed cost. Variable cost is equals to what? Is 3 naira. 3 naira minus 2 naira is the same thing as 1 naira. So 90,000 divided by 1 naira is what? Is 90,000 units, because we're talking about what? Break-even point in units. So it will be what? 90,000 units. Now, the break-even point in unit is equal to your fixed cost multiplied by the selling price divided by your contribution per unit, or selling price minus variable cost. Of course, the fixed cost multiplied by selling price equals to what? I talk about SP minus VC equals to what? Contribution per unit. That one has been established. Now, we have our fixed cost as 90,000 in the question. And then our selling price per unit is what? Is 3 naira. This 3 naira is 3 naira. You multiply this 3 naira with 90,000, you get 270. We now say, okay, 3 naira minus 2 naira is 1 naira. 270 minus, or 270 divided by 1 naira is something as what? 270. If you can see, we are getting the same amount in both formulas. Whether you're using the equation method or you're using the contribution margin method, you're getting the same quantity and the same value. So in the above, or it shows that what? A firm will be at a break-even point when it's producing and selling 90 units, or have a sales of what? 270,000 naira. So this is what we've arrived at. If the company want to break even from this our competition now, it must sell, or its sales must be up to what? 270,000 naira. Anything below this 270,000 naira, the firm will be losing. There will be a loss. The firm will incur loss. Anything above this 270,000 naira, the firm will be making profit. The same thing, if you want to know number of units to break even, we say to what? For the firm to break even, there will be no profit, no loss. It will have to produce 90,000 units. Any unit below 90,000, the firm will be making what? Making a loss. But if it want to make a profit, it has to produce over 90 units. 90,000 units, sorry, for it to make profit. Now I have the profit volume ratio, that's PV ratio. The profit volume ratio, or the PV ratio, total contribution divided by total sales, is called the profit volume ratio, or the PV ratio. The break-even point can be determined with what? With the help of a PV ratio. Take note, PV ratio is what? Contribution divided by sales. And what is contribution? Is what? Sales minus cost minus variable cost. So we say the PV ratio is something as what? Contribution over sales. We can say sales minus variable cost over sales. We can say 1 minus variable cost divided by sales. All this will give you the same thing. You can get it using either of these. We can say PV ratio equal to your fixed cost plus your profit plus your fixed cost. So fixed cost plus your profit over sales. And you have your fixed cost plus profit over sales. So this is the same thing. So this is fixed cost plus profit over sales. And this is F plus P over S, the same thing. But this is just a shortcut of it. F stands for the fixed cost, P stands for the profit, the S stands for our sales. So our PV ratio is what? Fixed cost plus profit, and then our S stands for sales. Now, if we want to calculate our break-even point in value, we'll now say, okay, fixed cost multiplied by total sales divided by total sales minus total variable cost. That is in total. Now, our fixed costs multiply by total sales divided by total contribution. The same thing when we say total sales minus variable cost is the same thing as total contribution. Take note. I say sales minus variable cost is what? Is contribution. Total sales minus variable cost is equals to what? Total contribution. Now, fixed cost over total contribution divided by total sales. Fixed cost over PV ratio give us what? Give us our break-even point in units. Variable cost, to sales is called variable cost ratio. Now we're done with this one. We're going to pick a question that has to do with this. We'll see how we go about it. Take note that if you want to calculate a break-even point in value, we can use the PV ratio, which is what? The fixed cost over contribution, or fixed cost divided by sales. Fixed cost plus profit divided by sales. That's it. Contribution over sales. That's it. 1 minus variable cost over sales. The same thing.